Hello and thanks for joining me. My name's Caleb Cole. This video is about 3 terms you need to know before you invest in real estate. A few of my followers have asked me to give a breakdown of the numbers of a real estate transaction, one that actually happened, what I bought it for, with the down payment I made, the interest rate, the income, the rent, the expenses, the mortgage payment, and the profit at sale. And I'd started to do that. I started a video about that, about a specific rental I own, and it just was getting all jumbled. So I deleted it and I started over, and I deleted that one and I started over, and I just realized, okay, I'm jumping into this too quickly. My audience, as far as I am aware, are people who want to get investing in real estate. They want to buy their first home. They want to buy their first real estate property, rental property. They want to do better at their finances and get some passive income going. And so I was realizing I was trying to do too much all at once. And so I took a step back and I thought, okay, what if I was talking to my younger brother who is 19 years old and he says, Caleb, I want to buy a rental property just like you. And so I'd say, okay, great. Let's go back to the beginning. Let's start at the basics and work our way through it. And so this is going to be one video in a series of videos that I'm going to go through the process of before you buy, while you're looking, when you close, after you buy, dealing with tenants, when to sell, how to determine your return on investment, all those things. So this is just the beginning stage of I want to invest in real estate. And there are 3 terms that are really critical to the process of buying real estate, because ultimately the goal of holding real estate, I think for everybody, is to make money with it. They either want to have something that's going up in value, they want to have cash flow, or they want to make money when they sell the property. And those 3 things right there are the 3 terms that you really got to get your mind around before you can accurately assess what properties to buy and set your expectations for how long it's going to take to get that money. So there are 3 ways that real estate, specifically talking about rental real estate, there are 3 ways that real estate makes you money, that real estate affects your return on investment, your ROI. They are net profit monthly, price appreciation, and principal paydown. First, the net profit. That's your cash flow. That is how much you make after you've paid all your expenses. The expenses that are involved with a rental real estate, are the mortgage payment. The mortgage payment will include your principal payment. That would be the amount of money that's going towards paying down the loan. Your interest portion of that payment, that's how much you're paying the bank for the privilege of borrowing that money. Also in that payment is your property taxes, which are divided into 12 monthly payments, and you pay that with your mortgage, and then once a year your mortgage company pays the property taxes. And almost always you also have insurance included in that payment. So one of the terms you may hear is PITI. What does that mean? Well, it's your principal, your interest, your taxes, and your insurance. So when they say your mortgage payment, your PITI payment, that's what they're referring to. Your mortgage principal balance, your mortgage interest that you're paying, your property's property taxes, and your property's insurance payment. So that's your first expense. Every month you're going to have to make that mortgage payment. And then you're also going to have costs of owning the property. That will involve maintenance. You'll have repairs that need to happen. You'll have expenses when the property is vacant, vacancy expenses. You're still going to have to make that mortgage payment even if you have no tenant in the property. You're going to have to pay the utility bill when there's no tenants in the property. Some properties you will pay water, sewer, garbage. Some properties you'll pay everything, although that's pretty unusual. And some properties you won't pay any utility payments, and the tenant will pay for all of them. The cash flow is the thing that's going to affect you most month to month. And it's going to fluctuate. Some months you're going to have no expenses, and some months you're going to have large expenses. And so you have to anticipate that that is going to happen, And as your money comes in from your rent, let's say you're making $1,500 in rent and your mortgage payment is $1,000, you have $500 a month that's coming in above and beyond your mortgage payment. Woohoo, $500 a month! Well, not really, because of all those expenses that are going to happen. You have to anticipate that the costs are going to come. And so if you have $500 a month coming in cash flow, don't spend that money. Put it aside, because eventually there's going to be an expense that you're going to have to pay for. A refrigerator's going to die, a stove is going to go out, a furnace is going to have to be replaced. You're going to have a tenant say, oh, I have to leave, and you take 2 weeks, 3 weeks to find a new tenant. Well, you have 3 weeks of no rent coming in. And so that $500 a month you need to build up so that it can be basically an emergency fund or a rainy day fund for the expenses that will happen. They're going to happen. So that's the first. Your net cash flow. After all your expenses, is there any money that's left over? Sometimes you'll have lots of money left over. Sometimes you'll have no money left over. And sometimes you'll have a negative. There have been many times I have had properties over the course of a year, the rent has not kept up with the expenses, and I've had to pull money out of my own pocket, either from other properties that I own or from income savings that we have from our jobs. Term number 2 that you need to think about: principal pay down. So every month in your mortgage payment, remember that PITI, principal portion of the mortgage payment, is how much you're reducing your monthly mortgage payment by each and every month. I'll pull up an example for you. Let's say you have a $200,000 mortgage. That's how much your loan balance is. You have an interest rate of 4.5%, and it's on a 30-year mortgage. Your principal and interest portion of that payment, not counting your property taxes and insurance, your principal and interest payment is $1,013 a month. In the first payment that you ever make, your first mortgage payment, $750 of that is interest. That's going to the bank. You're saying, thank you for letting me borrow your money. Here you go. Here's your interest payment. And $263.37 is paying down the principal on your loan. So the next month, instead of owing $200,000, you will owe $199,736. It will be reduced by the principal portion of your payment. It will be reduced by $263. So the next month, you will pay a little bit less in interest and a little bit more on your principal. And that principal pay down is money that's like you're putting into a savings account every month. Think of it that way. Every month that you make that mortgage payment, you're putting a portion of that into the bank account of the house, if you want to refer to it that way. So that when the house is paid off in 30 years, you have a house that is worth $200,000, and that has come from every month, little by little, you're paying down that $200,000. That principal pay down is a very important part of your real estate investing. It's money that you don't see. It's money that goes away every month that is building up in an account, basically. It's the same reason why I think everybody should buy their own property instead of renting. Because it's a forced savings account, essentially. Every month you make your payment, a portion of that payment is going to reduce the loan balance. And eventually, when you have no loan balance, that's party day. That's when the money really starts coming in. Or it's when you greatly reduce your expenses if it's your own house. So the first aspect to understand is your net cash flow. How much money is coming in every month that you have to put back into the property, essentially. It's not necessarily money that you're going to get to live on until more time has passed and rents have increased, so it's your cash flow. The second term to understand is principal pay down, principal reduction. How much money is going to pay down the mortgage every month? And the third is price appreciation. And this is the one that can make or break a property oftentimes. It's what can really get people caught up in the fervor and the excitement of buying real estate, because they can see, oh man, this person sold their property and they made $50,000. And that's true, it happens when the market is good. But when the market is bad, it's a different story. So what is that? What does that mean? Price appreciation. That means every year your house goes up in value. That's appreciation. If it goes down in value, that's depreciation. Historically, that price appreciation is about 5%, meaning every year your house, or the house next door to you, is going to be worth 5% more than it was the year before. Now there's some argument on that number because houses get bigger, and as houses get bigger, they get more expensive, and so it's hard to compare houses that were built in 1960, where they were 1,000 square foot, to houses that are built in 2015, where they're 2,500 square foot. And so, for my purposes, I always figure on a 3% appreciation rate. Basically, I figure on the inflation rate. I figure my properties are going to go up in value 3% a year. That's what I base my calculations on. That's what I decide whether or not it's worth it. That's how I decide what my potential ROI, my potential return on investment is going to be, is 3%. I figure that's very conservative, and if I have 3 really good years and 2 really flat years, or even 2 negative years, I'm probably still going to come out to 3% or greater. Here's an example of that $200,000 house. Year 1, it's worth $200,000, and the market goes up 3%. 3% of $200,000 is $6,000. So the next year, your house is worth $206,000. The next year, it goes up 3% again. It's worth $6,050 more. So it's now worth $212,050, and so on and so on and so on. And the longer you own your home, the more in value, percentage-wise, compared to what you bought it for, it's going to go up. Does that make sense? It's compound interest is what it is. It's compound interest in your house. It's worth more the next year, and so the amount that it's going to go up in value is even more than the year before, and so on and so on and so forth. And at 3%, your house is going to double in value. There's a trick if you want to know it. Divide your number by 72. So you want to know how long it's going to take for your house to double in value at 3%? Go 72 divided by 3. It's going to take about 24 years for your house to double in value. What if it were a 5% appreciation rate? It would take under 15 years for it to double in value. So I figure if I get a house on a 30-year mortgage, that in 30 years it's going to be worth 2 to 2.5 times more than what I spent on it today. That's pretty cool. But it takes you 30 years to get to that point. So let's recap what we talked about. The 3 terms that are very important when you're talking about investing in real estate and how you make money in real estate, how your return on investment is calculated when you're investing in real estate, is 1, the cash flow. How much money is left after the rent has paid the mortgage and after the rent has paid the expenses that come up with owning real estate. 2, your principal pay down. How much every month is going to reduce the loan balance on your home? And 3, price appreciation. What is the amount that your house is going to go up in value year over year over year? Those 3 numbers will be put together to determine what your return on investment is in your real estate portfolio. My goal has always been to make at least 10%. And because appreciation has been so great the last few years, that's a laughable number compared to what I've made return on investment the last few years. But I don't expect that to stay that way. Let me end with this. Real estate investing is a phenomenal option for everybody. Anybody can go out and invest in real estate. It's not as easy as putting your money in the stock market. It's not as easy as putting your money in a savings account in the bank. It takes a lot of thought. It takes a lot of patience. It takes some risk. And there's some anxiety that comes with it because you don't know what's going to happen. You don't know what those expenses are going to be. You don't know if the market's going to go way up or down. There's a potential to make a lot of money in real estate. And there's a potential to lose a lot of money in real estate. If you invest in real estate for the long term, almost always are you going to make money. If you invest in real estate for the short term, you might make a lot of money or you might lose a lot of money because you're dealing with big numbers here. You're dealing with hundreds of thousands of dollars, tens of thousands of dollars a year that are going out in rent, going out in mortgage payments. And so those big numbers can create big returns or big losses in the short term. In the long term, it evens out and it becomes pretty consistent. I've heard quite often people who have owned real estate for years and years and years are making usually between 12 and 15% return on their investment. If this video has been helpful, let me know, like it, share in the comments. If I was confusing or you still have questions, let me know. I'm going to be making a lot more videos about real estate and about real estate investing and about even buying your own home and how that can be even a potentially better investment than buying a rental property. Until next time, take care.